Well, good morning, everyone. Thank you for joining us for the 2020 spring economic forecast from Cal State Fullerton. As in the past, Mira and I will be presenting the forecast, but we have two panelists, distinguished panelists with us today, who will also provide their perspective on markets and the role of banking in the business. But before I go too far, I want to take a minute and invite the Dean of Mahalo College of Business and Economics to say a few welcome words. Dean Murtaza Rahmatian.
Thank you, Anil. Hello, and thank you for joining us on this live Zoom webinar, which is an extension of the Spring Economic Forecast presented by Mahalo College Woods Center for Economic Analysis and Forecasting. I am Murtaza Rahmatian, the Dean of Mahalo College of Business and Economics. I'd like to welcome all of you and thank you for attending this event this morning. I'm happy to introduce the webinar presenter today. First, our boss, Dr. Anil Puri, who is the Provost Emeritus and the Director of the Woods Center. Second presenter, Dr. Mira Farka, who is the center's co-director and also Associate Professor of Economics at Mahalo College. I'm also very pleased to introduce Mr. Jeff Van Harte, who is the Chair and Chief Investment Officer of Jackson Square. And also, I'm proud to add that Jeff is also a Cal State Fullerton Business School alumnus, the class of 1980. Our other guest is Mr. Ash Patel, who is the President and CEO of Commercial Bank of California. And I would like to extend a heartfelt thank you to Commercial Bank of California for sponsoring the economic forecast. Mr. Patel's ongoing generous support of Mahalo College is invaluable and greatly appreciated. Thank you, Jeff and Ash, for taking time to be with us today. I would also like to thank Warren Hannigan from Markham LLP, Steve Field from American Business Bank, Brian Skelton from Luther Burbank Saving, and Mo Saeed from Wells Fargo. I'm so pleased to see so many of you joining us virtually. This presentation is interactive and we look forward to your questions and comments. Please submit your questions via the Q&A feature throughout the webinar, and our panel will address them after the presentations. As many of you know, the Woods Center's economic forecast was released last week, and the pandemic and accompanying stay-at-home guidelines have a profound impact on our economy. As reported in our economic forecast, the region was looking forward to an increase in GDP. However, due to the unprecedented decline in most activities and economic measurements, obviously there are some changes that we're going to discuss. During this webinar, panel will provide with an update on the forecast, and we will do our best to answer your questions. We're very interested to know how and what you, the Orange County business professionals, are doing during this unprecedented economic times. Now I'd like to turn it back to our Provost Emeritus and the Director of Woods Center, Mr. Dr. Anil Puri. Anil, back to you.
Thank you very much, Mort. I appreciate your comments. And before I begin, let me just mention two things. As Dean Rahmatian mentioned, you have Q&A showing on your screen. Please do submit questions as you think of them, and we'll get back to as many of these as possible. Also, I am going to do a couple of quick polls and just to make sure that we keep you involved. And one of the polls is right now asking you to see if you got a chance to review the presentation at YouTube or not. And we'll just take about 10 seconds to do that polling. So give you some idea as to how much time we should be spending in different parts of that. So thank you very much for sharing information. We are going to launch into our forecast and provide you at least an overview of our presentation, which is already online. So let me begin with the title, The Virulent Year. We selected that title 3 months ago, but we didn't realize at that time how accurate this was going to be, how relevant this is going to be. This has been truly a problematic year. Thank you again to Commercial Bank of California and Ash Patel for providing us the support. No, this epidemic is like a ticking bomb or a wildfire that has affected the world as a whole. There are over 3 million cases throughout the world and 210,000 casualties, as you can see from this graph. In the US, we have had this virus from January. It's hard to tell actually when it started. We're still trying to determine. Data is one thing that is sparse and unreliable when it comes to this virus. The cases, the deaths, the hospitalization rates, some of these are known with some certainty, but others are very hard to determine. But there's no question that this virus has spread throughout the world. In the US, the numbers are reaching about 1 million as of this morning. About 56,000 or 60,000 people have died. In Orange County, you have seen this curve, I'm sure, before, where the vertical axis shows the number of cases and the right side, the horizontal axis, the number of days. I'm showing you the graph for just our region, other counties. These are the number of cases. As the graph bends, the increase in the number of cases becomes smaller and smaller. We have a little over 2,000 cases in Orange County. But as you can see, Orange County has been fortunate enough to bend the curve a little better than other counties. That may be because people are paying more attention to stay at home and lockdown orders than others. And similarly, for the number of deaths, Orange County has done better than the region as a whole. But the country, the world as a whole is struggling with how to deal with this virus because there are no therapies, no vaccine. And the only way to deal with it is by staying at home, shutting down businesses, keeping people from mixing with each other, social distancing, and so on. That's the only way we can deal with this at this time. On the other side, on the economic side, this virus has made the whole world at a standstill position. Businesses have shut down, majority of them, if not almost all of them, in the US and abroad. It's like an induced coma, and there is no precedent. It has led to such an unreal situation, both in the business and private lives of people, that it definitely is unprecedented in our lifetime, but maybe ever where such a shutdown has taken place. And you wonder where you are. You can't help thinking of Wizard of Oz and how Dorothy must have felt. We're not in Kansas anymore. No, we're not. It certainly does not look normal. It is not normal. The question, as often happens when there's a panic situation, when there's a crisis, stock market is the first to react and reflects people's feeling. And the stock market have followed the ups and downs of the coronavirus and what the government has done. Starting with the first cases in the late January, stock market started to fumble, so to speak. And as more news came into light, Italy outbreak and Spain and other places, stock market continued to decline. World Health Organization declared it to be a global pandemic. And then administration started talking about this virus continuing at its fierce pace through August, which led to about 12% decline in one day. And then if that wasn't enough, Saudi Arabia and Russia started to fight over oil, and oil prices went down. And so by the time we got to March 23rd, stock market has fallen 35%. And we knew we are in deep trouble. The government knew we were in deep trouble and something had to be done. And that's when the CARES Act was passed with a massive $2.3 trillion worth of support being provided to the country. Now, This stock market fall, 35%, is not the largest. Great Depression was the largest. But it is the quickest, sharpest decline that we have seen of any of the declines in the United States. 73, 74, 55%, the dot-com, 41% total decline, and the financial crisis of 2008-9, 57%. But look at the current decline of 35%, within like 23 days, I think, it fell 35%, sharpest ever. Now, oil, as I mentioned earlier, took a real tumble, and as you probably have been watching news, the futures price went down to zero, negative actually. There seemed to be a little truce between Russia and Saudi Arabia, but that is not going to be enough to help the situation a whole lot, given the abundance of supply of oil and fall in demand that has taken place. Brent crude has dropped to its historic levels, and we don't see a recovery, major recovery in this. Oil is a big thing for the United States. About 10% of the GDP growth comes from oil. Oil industry is about 8% of the US economy. So it is worrisome. But the good thing, if there is a good thing about this whole situation, is how the Federal Reserve Bank and the federal government have responded to this crisis. Federal Reserve Bank is in it full bore, no holds barred. They're fully in. And as you know, they cut interest rates. They have started quantitative easing and also started to provide forward guidance. And until the economy recovers, they're going to keep the rates to zero. In addition to that, Federal Reserve Bank has, as you know, come in a big way in supporting the credit markets. Lending of all kinds, SBA, Main Street lending, corporate bonds, and even bonds which are just below this junk bond rating. So there's nothing that Fed is not willing to support, whatever it takes. They're all in. And that has stabilized the credit markets. There are some long-run consequences of it that we'll talk about later on, but there's no question that the Fed's action went a long way in stabilizing the stock market and the credit markets. Federal government, Congress, and the president, they have also stepped up to the task. There were 3 different measures that have been passed, and I know that you've heard a lot about these, so I'm going to go through it rather quickly. Phase 1 was $8.3 billion, mostly for public health and social services, and also for international effort, $1.6 billion. Phase 2, $172 billion for tax credit, for unemployment insurance, for Medicaid. But the biggie was phase 3. These first 2 phases obviously weren't enough. We needed a bigger boat. It was very clear. And that third phase of $2.3 trillion, $510 billion for the support of businesses, $350 billion for small businesses, and PPP, Payroll Protection Program. We'll talk a little bit more about that. $290 billion for individuals, $1,200 a person check, up to a certain limit, $75,000 for individuals and twice as much for families. Business cuts, unemployment insurance, you name it. There's a whole list of items that this bill passed. Not only the size of this is impressive, but the speed with which Congress came together, given the partisan nature of Congress right now, was very impressive. In 2008 and 9, the total government support added up to about 6% of GDP. We already have about 11% of GDP in terms of these stimulus measures. The small business help, let's talk about that for a second. The monthly payroll expenses we estimate for small businesses are about $282 billion. CARES Act provided for $350 billion, which wasn't enough. So the government passed a phase 3.5, you might call it, just last week, $480-some billion, $320 billion of which was allocated to PPP. Now that is going to last about 3 months in terms of payroll, and we'll see what happens after that. So small business, in addition to the $320 billion for small business in the 3.5 measure, phase 3.5, that is. There's other $60 billion for disaster loans. Hospitals get 75, and testing for about $25 billion. So along with these measures to help the businesses, individual checks of $290 billion. But if you look at-risk workers and how much they've lost in salary and wages, we estimate that's about $900 billion worth. So about a third of that, $290 billion, $300 billion, will help individuals somewhat, but it's not going to fully compensate the workers for the lost income. Everybody's looking for money. More and more is needed in spite of all that. And we'll see if all these measures, how far they're going to go. It all depends on the speed with which we can deal with the virus. Now, going forward, we think we're still going to have to come up with additional support, because these measures, we shouldn't call them stimulus measures. They're basically stabilization measures. When the economy starts to recover, we are going to need some more help from the government. But before we delve into those issues, I'm going to stop here and turn it over to Mira so that she can continue the conversation. Mira?
Thank you, Anil. Can you hear me okay?
Yes.
Okay, perfect. Thanks, Anil. Let me get this going here for a second. Good morning, everyone. First and foremost, I hope you and your loved ones are safe and healthy. Second, let me just start this presentation with an unusual plea. Please don't shoot the messenger. I mean, some of the data that we're actually going to share with you guys is going to be a little bit disturbing. Actually, they paint quite a dark picture, especially in the short run. So you've heard about the Great Depression, you've heard about the Great Recession. We're calling this the Great Disruption. And yes, life is like a box of chocolates. You never know what you're going to get. Unfortunately, this time around, we ended up with sort of quite a bitter and somewhat poisonous chocolate that not only will actually make us sick for a little while, but also kind of leave a lingering bad taste in our mouth for a little bit, for probably about 6 to 8 quarters or so. So please don't shoot the messenger when it comes to that. Now, no one doubts that we're actually in the midst of a recession. I mean, that goes without saying. The question is, how deep and how long? In other words, how black is this swan? And when we talk about recessions, we normally, we look at 3 dimensions, 3 factors, right? We look at the depth, we look at the diffusion or the breadth of the recession, and we look at sort of the duration of it. And when it comes to the 3 Ds, so to speak, right? And when you look at these 3 Ds, we think that this recession will be rather short, will be sort of a bitter and nasty, kind of a nasty recession while it lasts. And that's because the pandemic is hammering both the supply and the demand side. I mean, if you look at the supply side, obviously, it's shut down the vast majority of businesses. Over 90% of beauty and personal care, over 91% of leisure and entertainment, food and drink, all sorts of small businesses have actually closed across the US and across the globe. I mean, in a sense, you can think of it as the government across the world sort of took a sledgehammer to a tiny germ that is literally 1/10 of a thousandth of a millimeter. Now, of course, revenues are cratered across the globe, across the board. You got lodging down 86%, bars and restaurants down 50, 60%. Retail is down. Now, you wouldn't be surprised. Some sectors are actually doing okay. If you look, for example, grocery store, it wouldn't come as a surprise that those revenues are up. And by the way, gun sales are through the roof. But if you look at it, so you see this kind of idiosyncratic responses. But if you look at it from a supply perspective, a back of an envelope calculation that we did sort of informs us that roughly about 32% of GDP, of the share of GDP is lost during this shutdown. And if you want to translate this in terms of the monthly revenues that are lost, the output lost per month, that's roughly about 600 billion. So it's quite substantial. Now, what started as a supply shock also has morphed into a demand shock. We actually have lost 26 million jobs. This is widely reported so far. And the jobs at risk, interestingly, depend on whether your job is classified as essential or not. Now, we do know who your essential workers are. You've got your healthcare workers, your police, the grocery store, the delivery truck, and so on. There are, however, a couple of sort of dodgy categories, I would say, a bit questionable. 100% of government is deemed essential. I guess we shouldn't be too surprised about it. Marijuana stores are deemed essential. I'd be the last person to grant with that, given that we're all stuck inside our homes. But also know who our non-essential employees are. Me and Anil are kind of have made peace with it. And it kind of feels a little bit liberated to be non-essential. Now, to understand sort of like the depth and the breadth of the labor market shock, we did sort of another back of an envelope calculations, and it depends on not only whether you're classified as essential or not, but whether you can work remotely. And if you look at the sort of broad overview, there's about 58% of employment in the US, which translates to about 88 million people, could be classified as essential. Now, so these people we can consider safe, for the time being at least. The non-essential workers, the remaining 42%, this translates to about 64 million people. Now, these workers whose jobs appear to be more at risk, about 30% have the ability to work from home. So this translates to about 19 million people. The remaining, though, the 70% that cannot work from home, this is around 45 million, and these are the jobs at risk. Now, of course, 26 million people have lost their job. These are most likely furloughed, and most of them will be hired back when we reopen. But on top of that, we still have about the remaining of this either the 45 million, 26 have lost the job, but more jobs are at risk. Now, if you look at it from a perspective of a sectoral view, obviously the top of the list are leisure and hospitality. We think about 12.6 million jobs are at risk in this sector, followed by professional services. 8.2 million jobs are still at risk. Wholesale and retail, 7.5, followed by the rest of the sectors. But at the bottom, you see transportation and utility. These are at least, these jobs are at least, they're not as much at risk, partially because they're qualified as essential. Now, if you do a similar calculation for the local market, our back of an envelope calculation shows that there's about 1.13 million workers in LA County that are at risk. In Orange County, that number is about 420,000. And in Inland Empire, is about 520,000 workers. So this recession is deep and broad, not only from a supply side, but certainly from a demand perspective, as you see, because it hits all the sectors. The other very important question, though, is duration. I mean, how long will this go on? The duration is actually key, because the longer this goes on, the more painful it will be. And some of the scars that we're actually inflicting on the economy right now may actually become permanent. Now, the problem with this is that we don't know the duration of this. As Dr. Fauci said, you don't make the timeline, the virus makes the timeline. So this is what makes this forecasting very difficult, especially in this time. Now, we're assuming, now we have to make some assumptions for our forecast in order to come up with our projections. And our assumptions are pretty much plain vanilla, what we hear from the officials. I mean, they're telling us we're assuming that the grand reopening will be sort of fitful, fragile, partial. It will be non-synchronous, meaning different places open at different times. We see a partial reopening by the end of May, early June, perhaps some places opening in July. But these will be happening under strict conditioning, obviously more testing, social distancing, restrictions on large gathering, and so on. In terms of the virus timeline, we're assuming that we'll have perhaps some kind of therapeutic drugs by late summer, targeted antibodies by fall, but not a vaccine will likely not be available until mid-2021. Again, none of these are controversial. This is what we hear from the public officials. Now, the question is, what is the shape of this recovery? When we reopen, what would it look like? Well, we think that what started as a temporary shutdown will probably leave some scars, perhaps not permanent, but at least over the next 6 to 8 quarters. So not everything that basically was lost during this ice age, if you will be fully recovered, at least not immediately. Take, for example, consumption. You have to look all the way back to the 1950s recession to look at a couple of quarters that are greater than 10% consumption drop. There was another bad quarter in the second quarter of 1980 during that recession, but this pales in comparison with what we're actually looking for, what we've penciled in terms of how much consumption will collapse this quarter. And we think it's going to be roughly almost 30%. I mean, once we hoarded all the toilet paper, like in Layton over here, Americans went home, locked out, and never looked back. Now, don't get us wrong. We do think that the third quarter will be likely the best on record, the best we've ever seen. There's a lot of pent-up demand over there, that, especially for services, that sort of that trip to the barber and the hair salon and the nail salon, God knows I need one, to a favorite food place. Obviously, we'll see this come back, but we don't think that consumption will recover fully, not until the end of 2021. And part of the reason for this is that the shutdown has had a devastating impact on businesses, small and large. In fact, I mean, take, for example, small businesses. If you look at the National Federation of Independent Businesses ran a survey just recently and discovered a lot of small businesses have very little cash buffers, right? There's very little operating margin left. Most of them, 50%, have less than 2 months worth of cash. In fact, restaurants and retail have less than 20 days. Only 31% have between 3 to 6 months of cash laying around. So these are a real tough time for small businesses. But another worry is that a lot of this, even the help that and the aid that Anil was just describing, may be coming a little too late. I mean, if you look at the first tranche of the PPP, 1.6 million, only 1.6 million of small businesses out of 30 million have received some kind of aid so far. And even if you kind of put together the second tranche that was just released this past week, this only covers about 25% of annual payroll. If you add to that the fixed costs that these small businesses sort of face, they'll last on average about 2 months. So again, it's a bit too little, too late. And another concern is that basically after the grand reopening, after we come back and we reopen, some of these businesses, especially those on high contact, would have a tough time operating in a 6 feet distance economy, in this social distancing type of economy that has been envisioned for a while. So this worries us because obviously this means that some small businesses may never survive this, whether it's the shutdown or the sort of this tentative reopening. And we worry that there will be no soup for us in our favorite restaurants. We hope we're wrong, but that's one of the main concerns. And this matters greatly because small businesses do employ about 48% of the workforce nationally. The number is bigger locally, 51.4%. Of employees in Orange County are in small businesses, 52% are employed by small businesses in LA County. So this matters greatly. Large corporations are also in big trouble. We do think this pandemic has sort of exposed some of the deeper cracks that existed before. And one that we've been warning about for quite a while is certainly corporate debt. It's skyrocketed to 74% of GDP. It's the highest it's ever been. And more concerning is the fact that, this debt is it's not just the debt itself, but the quality of the debt. I mean, if you look at it in terms of corporate bond debt rating, 3 trillion of this debt is actually investment grade. About 3 trillion is B rated, which is basically a notch above junk. And you've got about 1.3 trillion that are in junk bonds. If you add to that the leveraged loans, which are about 1.4 trillion, you've got a $2.7 trillion debt that is sort of at risk, right? So the worry is that given the revenue losses, and in some sectors, they may come up to 50, 60% in the second quarter and so on. The worry is that, the liquidity crisis that most of these corporations are experiencing now may turn into a solvency crisis. So these are some of the concerns. So the question is, what is the shape of the recovery that we're envisioning? Will this be a V-shaped recovery where we fall deep and we recover very fast? Will it be an L shape, which is kind of a depression, or sort of a U shape where we linger at the bottom? Well, we think this recovery will look a little bit more of a W shape. And here are our GDP forecasts brought to you by letter W. So we think that when we reopen, we have that pent-up demand and the massive rehiring with lots of jobs that were lost coming back, but we don't think it'll be enough to take us back to where we were pre-crisis, pre-COVID-19. And in fact, we think that even by the end of 2021, GDP will be about 1.3% below pre-crisis. If you want to look at it in terms of our forecast for 2020, we pencil almost a 4% drop in GDP and a 2.2% increase next year. Unemployment rates are also going to shoot up high, 14.2%, the average of the second quarter. In May will be even higher. We're thinking 17.4%. But then even by the end of 2021, again, unemployment rate will drop, but still will be high, 6.2% by the end of the forecast period, which is the end of 2021. Averages will be 2020, the unemployment rate about almost 9%. Next year, 6.8%. So where does this leave us? Well, I would say first, I thank you for not shooting me. You guys have been real troopers. And let me end on a positive note. Since I started with Forrest Gump, let me end on Forrest Gump. And let me remind you that, as Forrest Gump said, miracles happen every day. So let's hope. We are long overdue for we need a miracle right now. We need a medical miracle right now. Let's hope and pray it happens soon. And with that, I thank you, and I'll turn it over to Anil.
Thank you, Mira. Let me continue the story, but before I do that, let me just have this little poll and see how many of you really panicked and did your shopping at Costco. Just take
toilet paper specifically.
Toilet paper in particular. Thank you very much. Majority of you seem like did go there, and here are the results. Let me begin. Let me continue the story from where we were, where we started. Just a second. Let me. Here we go. One area that we want to cover, and Mira referred to it, I believe, is real estate. You know, the story is different when you look at residential market versus the commercial market. The residential market has been pretty slow. Supplies have been limited. We think that coronavirus will have some impact on the housing prices. They will decline 5% or thereabout, but not beyond that. And we think there'll be a slow recovery next year, but still housing prices will be not going anywhere within the next 2 years. Commercial markets, however, are different. Commercial markets are already up there, especially office market. And we think it's going to take a larger tumble. My screen seems to be, no, there we go. It's going to take a larger tumble. And part of it, part of the reason is that, especially after the coronavirus impact, there's a lot more work from home. And we don't know whether people are going to go back to physical buildings, not to the extent that they were doing before. So given that they're already inflated prices, we expect a much sharper decline for the commercial markets. I am not sure why the screen is freezing. Coming down to Orange County now, as you can see from Mira's forecast on the national level, we want to look at Orange County and see what's happening down here. Employment Development Department and the historical data, unfortunately, is no longer providing much help because this is not like normal times. We have been using a survey that we have been doing for the last 20 years. Many of you participate in that. And we create an index, OCBS index, that tells us about business expectations about the coming quarter. As you can see, for this quarter, the survey was conducted in the third week of March, just when we were learning the extent of the virus. The index fell from 93%, 92.9 points, to 22.7%, the sharpest decline other than the financial crisis when it dropped below 20 points. We think employment is going to follow the same path and have a sharp decline in that. Local economy, when we asked the executives about what they expect for profits, previous quarter they expected 82% expected higher profits. Now 77% are expecting lower profits in the fourth quarter, in the second quarter of this year. Sales, again, same story, from about 92% expecting improving sales, about 72% expect declining sales. And of course, when it comes to hiring, from overwhelming number of employers who plan to keep the same employees, in fact, increase the number now 96% of them intend to keep the same or decrease rather. And at least half the firms in Orange County are planning to lay people off in the second quarter. Disneyland, what a sad story. Instead of booming and hard to get into place, Disneyland picture right now is a deserted place. Disneyland company is suffering, of course, but the employees of the Disneyland and Orange County are having a similar fate. Now, the question is, what can we say about Orange County's economy? Since historical data are not very relevant, we thought we'd look at the previous episode, sharp recession, 2008 and 9. At that time, at the beginning of the recession, before the recession started, unemployment nationally was 5%, Orange County 4.4%. In the depth of the recession, both of these rates doubled, almost 10% for US and Orange County. It took 5 years for unemployment rate to fall to 5.7% nationally and 5% for Orange County. And it took another 5 for unemployment rates to fall below 4%. So it was a very slow recovery. Now, having said that, and based on the analysis that we have done of how many people are going to be subjected to unemployment, we estimate that Orange County's unemployment rate in the second quarter will jump to 11.5% on average. But I think for the month of April and May, it wouldn't be surprising to see 15% or 17% unemployment rate temporarily, and then it starts coming down. But we think it still will take some time before the unemployment level falls to what we have today or close to it. Even by the end of 2021, we expect the unemployment rate to be at least 4.5%. On an annual basis, compared to 2019, where we had only about 3.5% average, we're going to have 7% average unemployment rate this year and 5.3% in the coming year. But this is a very sharp recession. We are in a recession, there's no question about it. But we have faith in the American ingenuity, our hard work, our people working together, that we are going to come back, that we are going to come back stronger, and we'll be better at the end of it than we are today. Before I turn it over to my panelists, I want to do a quick poll. I'm sorry, let me just get to it. And I want to see what you are expecting in terms of going back to work. Do you expect to go back to work in the next few months? Or do you think that given the state we are in and the economy where it's at, that it's going to take much longer? I'm going to give you just a few more seconds. Results are coming in fast. That's great. And let me share the results here for you. Over 58% expect to go back to work in May and June, and the rest later. So let me now bring our panelists, Jeff Van Harte. Jeff is the founder and chairman of Jackson Square's Partner, a large money management company located in San Francisco. He's our alum. Jeff, it's all to you.
Thanks, Anil. And just to pick up on that, Jackson Square manages about $19 billion for large institutions and individuals, mostly in the growth space. So I'll try to get quickly through the slides here, Anil. The first slide that I have is on the composition of the markets. And really the point I wanted to make to you is that it's really not one stock market, it's two since the beginning of the year. You can see that returns really for the top 6 sectors in the S&P 500, had you invested proportionally, are only down about 5% and comprise over 70%, over 73% of the S&P 500. And the bottom 5 sectors, had you invested proportionally, you would have been down almost 27%. And they comprise now less than 30% of the S&P 500. That's sort of relevant to my comments going forward. Obviously, those bottom sectors tend to be asset heavy, more debt heavy sectors. On the next slide, just 5 quick conclusions from the post-COVID for the post-COVID investment world, and there may be more coming over time. But first off, we just think online and digital commerce acceleration will occur. Obviously, online has been going on for many, many years, but when you have a crisis, it tends to accentuate trends that are already in place. In particular, we think companies in the software as a service space will really do well coming out of this recession. As I mentioned, and as you can see from the stock market charts, debt financed hard assets are in oversupply, and is also indicated in both Mira's and Anil's presentation. Places or spaces like commercial real estate, retail, energy, manufacturing, probably my sense would be in a slow recovery, probably an oversupply for quite some time in spaces to stay away from. Really kind of think that, this is really the end of global trade as we know it. It's certainly not the end of global trade, but that narrative was dominated for a long time by the United States and China, and that obviously that relationship started to fray going into this year and before we had this crisis. So we think, that is, going forward, supply chains are likely to be rerouted, and in the interest of national security, countries will start to diversify away from China. We think the zero interest rate world, at least in the treasury market, is here to stay for quite some time. We're obviously financing huge, huge deficits, and it's in the interest of central bankers around the world to keep interest rates fairly low. So we think that has implications going forward. And then finally, and very unfortunately, this is such a sharp recession. It's really, for the time being, accentuated the wealth divide, and there are ultimately solutions to that maybe could be in the private sector, but certainly has very big political ramifications. Going to the next slide on investment questions and implications, we've sort of concluded that savers will be penalized with lower rates. It's politically more expedient to penalize savers. But if you were counting on passive income or interest income in your budgets, it's probably going to be down for quite some time. We think that may highlight companies with sustainable and growing dividends, and companies that have traditionally repurchased shares may not play as much, especially in sectors like banks and airlines. As I mentioned, asset heavy, debt heavy versus asset light and low debt companies are a consideration. It's sort of like talking about the difference between growth and value investing. It's very, very hard when you have overcapacity and high fixed cost and a reasonable amount of leverage, as indicated by the growth and corporate debt. Those businesses, I think, will struggle for quite some time. So we favor growth investing. I mentioned peak China and supply chains. Fiat currencies are obviously in play here in terms of the amount of money we're going to print to finance deficits. So looking at assets of limited supply, certainly not something we do at Jackson Square Partners, but maybe having a little gold in your portfolio, maybe even some Bitcoin, but also companies, unique and rare growth companies, could be counted as assets of limited supply. Excuse me. So I think that's a consideration, especially in a world where we've got huge deficits. And then the wealth divide brings up political outcomes. It's sort of like, how do you solve it? Do you think about it in terms of wealth creation or wealth redistribution? We're on a presidential election cycle here this year, and depending on who wins, that's something to watch. Generally speaking, the market doesn't like it when we start to do wealth redistribution, so something to keep an eye on. And then finally, does the Fed put work again? So far, seems to be. The confidence in central banks seems to be never ending. But you do have to consider that, this time, probably the solution out of this is really not the Fed. Ultimately, it's going to be a medical science solution. So on my last slide, just to end, on a little brighter note, is that, I think the change in behavior that we're looking for and we all want in terms of economic behavior is really going to be driven by medical science. In that regard, we follow it pretty closely at Jackson Square because we have healthcare investments, but the amount of capital and intellectual firepower that's being thrown at this is truly stunning, and it just increases the odds that we'll have a solution sooner rather than later, whether it's through effective antivirals or ultimately a vaccine. So I'll conclude on that, Anil. I hope I hit my 5 minutes, and that's it.
Yes. Thank you so much. Let me now bring Ash Patel, CEO of Commercial Bank of California, for his comments. Ash?
Good. Good morning, everybody. I just have a couple of quick comments with respects to what's I think on everybody's mind right now, since this is an economic forecast and since everybody's focused on the PPP side. So I'll just give you a little bit about what specifics that CBC has done to help. Yesterday, like Anil said, the second tranche of the PPP was opened up yesterday. So what CBC is doing to help our local community, we've done all three of them. So we have the PPP loan, the economic injury disaster loan, and developing long-term relationships. I'll talk a little bit about the PPP loan. It was kind of unfortunate. It was nice to hear that there were 30 million businesses that are in the United States and only 1.8 million got them. In fact, yesterday, I think the news came out that only 100,000 applications were approved by the SBA and the system crashed 3 times. So it's very, very discouraging where, we need to get the money out to the individual businesses that need the money. The banks have been given the opportunity to give the money, but the infrastructure that it is and the plumbing and the piping that's been used to get the money out isn't working. So it is very frustrating for bankers like us who've worked all weekend long to give out monies for PPP. So anybody that has any questions, I'm happy to address it. Just talking about the whole payroll protection plan, the big banks have been very, very difficult to deal with because we have been dealing with that. So I can understand the frustrations the small business today is having when you have high unemployment, you have money available from the government, banks have the money, but yet it's not getting into the individual hands where it needs to get to. So those are the only few topics I'd like to touch point on. One of the things I'd recommend is a smaller community bank where the decision-making is local, the machinery is a little quicker and faster to get the money out on the PPP side. The economic injury disaster loan is another loan that I think it's important that people should be aware of so that they can go to their local banks. It's directly done through the SBA.gov that you can apply for those. And then there's 2 other SBA programs. So I'd like to take questions because I can continue to share more information on PPP, but treasury.gov plus SBA.gov has a lot of information that is out there in terms of what to do, how to do. We are available, CBC is available, and in any local community bank will be happy to help you. And we are here to help any questions. I'll leave my email with Anil and you can ask us. I think it's very specific topics that you need, but we're doing everything we can to assist the local community to get the community back to work and support the local community. Our bank alone, we're a small $1.2 billion bank, and we have so far approved $250 million. For a little bank like ours, 600 loans have been approved, $256 million have been approved by us. Anil?
Thank you, Ash. I'm just running a poll, just asking people if they have applied for PPP or not. And I thought this will be an interesting number for all of us to see to what extent all the money that government has allocated is actually getting into the hands of people who need it, and to the extent that it will help. So here are the numbers. I'm going to share the results. 60% have not applied, 40% have applied, but I'm not sure how many of the respondents are actually owners of businesses, small businesses that, in any case, we are going to turn it over to now our 2 moderators. Dean Ramatian has gracefully agreed to pick the questions that you have submitted, and Dan Coates. So please ask the question that audience has submitted.
Can you hear me?
Yes.
Yes. The first question is, when you selected the topic 3 months ago, before the virus was a big issue, what turbulence were you expecting? How did that affect the virus?
Well, Mira and I will probably take that. When we selected that topic, we were thinking of domestic problems. There was impeachment, seems like a long time ago. There was partisanship, government wasn't functioning, economy has started to slow down. And so an election was coming up. So we expected it to be very turbulent, but not virulent in the sense of a virus. We had no idea. Yeah, right?
I disagree, Anil. I think let me refresh your memory a little bit. We actually decided on the title on January 28th. That was a few days after China went locked down. So the viral was a play on Chinese lockdown of Wuhan.
We didn't know the extent of
We
it.
never thought it was going to be this bad. I totally agree. But it was a play off of that. And it was both on the virulent year was mostly about the election risk at that point, yes. But we did speak in that word because we thought it would be appropriate given what was going on in China and potentially that.
All I can say, we got to be careful of how we pick our words because
I know. Prophetic.
Okay, go ahead, please. Next question.
Okay, so can everyone hear me okay?
Yes.
Yes.
Okay, so the next question is a desire for clarification that the 45 million workers at risk for job losses, does that include the 26 million jobs already lost?
Yes, that was I think from my slide. Yeah, so we did a back of an envelope calculation. 45 million were at risk. 26 had already lost that job, which leave us about 19 million still at risk. That was the point I was trying to make. Obviously, if the shutdown ends soon, those jobs will no longer hopefully be at risk. I mean, they may be at risk for other reasons because we think it's going to be lingering effects of this sort of people sort of hesitant and tepid kind of opening and reopening, but that would be for other reasons. So we don't think 19 million are still at risk if the shutdown continues much longer.
Next question. 58% of the workers are essential and getting normal paycheck. How much of the sales slack has been picked up by online shopping?
Well, we can only speculate until we actually get the data. There is no question that there's a huge hit to retail and certainly restaurant industry and entertainment. I would say that retail sales are down over 50%. Online shopping, Amazon is the big kahuna there, and others too. But I would be surprised if it's less than 50% in terms of purchase buying that the public does. Mira?
No, I agree. So the 58% of essentials, obviously, Anil and I did not make the cut, as you get the point, for the 58% essentials. No, and I'm certainly not shopping, even though I still have a job. I can work remotely. I think what's playing in the psyches of people is normally you would see a huge increase in online retail. And that has happened, as Anil mentioned, Amazon, but not to the extent that you would hope at this stage. And part of the reason is, of course, the huge uncertainty. People don't know when they're going back to work. People don't know that even if you go back to work and you still have a job, what the outlook will look for revenues. And we still have a pretty bleak outlook for revenues and corporate earnings for the remainder of the year. So people are quite hesitant. And that feeds into what Anil was discussing earlier when it came to housing prices. Even though we don't see a collapse nowhere near to the extent that we saw during the Great Recession, obviously housing prices will take a little bit of a hit, partially because people are hesitant. And sort of, this is sort of the new world that the reopening will not give us back to normal level where we were, at least not where we were pre-crisis. We don't think this is going to last 10 years, but certainly it will last a couple of quarters, probably a couple of years. Anil?
No, go ahead. Next question. Let's move on to.
Okay, so the next question would be, actual statistics show that 95% of COVID-19 fatalities are with people who have underlying illnesses, and many people don't have underlying illnesses. So the question would be, could we only protect those who are at risk and let everyone else go back to normal life?
Well, I invite other panelists to jump in too. It's not really only an economic forecasting question. Jeff, Ash, if you want to take that.
I have one comment. One country that's sort of trying a different approach right now is Sweden. And they've allowed the population to work a little more normally than what we've seen in other parts of the world. And although their infection rates are higher, they're not really as high as you might think. And so, I think the general answer to that question is yes. And I ultimately think that all countries are sort of headed that direction of Sweden, where members of the population that are more at risk are going to be isolated. And, we will deal with outbreaks on a very specific basis. But Sweden's an interesting example to look at.
And I can add that too. I think Germany did the same thing yesterday. Germany opened up the restaurants yesterday and have done exactly that. They've geocoded or geofenced individuals that have symptomatic approaches and have started to isolate those or contain those within the areas where they are. I think it's a great approach to get the economy back, is to isolate the individuals or segregate them, not in quarantine, but just use those common sense methodologies so that people that are antibodies, that's another way interesting thing that has come up, is only a very small portion of the coronavirus infected individuals actually have any fatalities. They recover well after 21 days of quarantine. They come back. When you look at, even celebrities like Tom Hanks and those that were there, the Cuomos, you can see that they were quarantined for 21 days and they come out and they're able to be finally, they get back into the population. So I think it's a great suggestion that we should be considering those.
Yeah, one thing is clear, that this virus is not going to go away by itself. It's until we find a vaccine. And in the meantime, it's going to continue at a certain pace. And secondly, I feel that we don't really understand how the virus affects different people, different ages, different sex groups, different health status, and many other ways. So it's very hard to really project a path into the future. But there is no question that we have to continue to have judicious social distancing and open the economy, but not wholesale blanket opening, but a more nuanced one. Mira, you want to say something?
Yeah, actually, I thought I'd be a minority but I think I agree with Jeff and Ash. I do think this was a hatchet approach. It was a sledgehammer approach to the economy. This radical draconian measures of a shutdown are extremely harmful, obviously, to the economy as we know it. And it could have been done a lot smarter. I think when we look back at this whole exercise, my own personal feeling we'll find out is that it was a huge mistake to lock down entire countries. We would have done smarter, better, isolating the vulnerable, isolating the nursing homes and the older and the sick and those with comorbidities. But taking this, now that we are where we are, reopening may be interesting how we move forward. The virus is out there. The virus, you cannot, in a sense, we're kind of shutting our doors, hoping to get away from the virus, but it's still out there. So my question is, how would you reopen? And the best, and I agree with Jeff, the Sweden experience was the most interesting, even though they felt a lot of political pressure, they didn't bend. We'll see how they work out. And when it comes to the cases are high, but the fatality rates are not that high. So that would be an interest. I'm glad that some countries experienced it with had different experiences with it, because we will learn from it. Again, I think I'm a little bit in a minority when I think this was a very draconian approach to perhaps what we're finding out, something that is not as fatal as we thought originally.
I see a whole bunch of other questions.
Yes. I believe you said the housing prices in Orange County would decline in 2020 as a whole. Do you have any estimate of by how much?
Our estimate is that the housing price in Orange County, single-family homes, will fall by about 5% by the end of this year. It'll start picking up a little bit as the economy opens and we find a vaccine, things get back to normal. But the improvement will be very slow in the coming year. We're not going to be changing the supply side, and the demand side is going to be affected as well, because it's unclear how quickly people will recover their jobs and income. So by the end of 2021, housing prices, we expect it to be about the same level where we are now, or slightly below, actually. Next question.
Okay, so national debt has gone up to $3 trillion. So how will that be repaid?
Very good question. I know Jeff is itching to answer that. But I know that those debt and the expanded role of the Federal Reserve Bank, at some point, these have to be rolled back, the Fed's role in particular. And there are different scenarios. We have been accumulating debt for some time, and this is unprecedented. The only one way is to raise taxes. Other way is to monetize it, lead to more inflation, and other cons. There are no good ways to undo it. But I will let other panelists chime in. I'm sure everybody has a view on this.
Well, I saw another question on there, Neil, about last time maybe deficits didn't matter. But what I would say to that question is, 3 trillion is just the start here. We haven't talked about Europe and what's going on in South America, and European bank ties to South America and energy markets. I mean, we're going to go off the charts here in terms of creating money to pay for this. And I think it's necessary. I think we have to do it. I don't really know how else to do it because otherwise we have social unrest. But that's really the only solution. And so again, I just come back to, from assets of limited supply. And I do think it's prudent to have, this is my cave, but I don't have shotguns and gold sitting around here. But I think it's prudent to have a little bit of that kind of protection in your portfolio. But truly, this is really unprecedented. And if you thought $1 trillion deficit was daunting for the United States, well, I say to you and Mira, I don't know where we're going to be now, but it's in the multiple trillions.
Mira, what do you think?
So, no, I mean, I have no good answer, unfortunately. So we know how you get out of debt. You basically, as Anil mentioned, you raise taxes, you monetize the debt. That's what we're doing, obviously. You default. It's certainly nobody's first choice, or you grow out of debt. Mm-hmm. My hope is we do the last. Let's hope that when we get out of here, we really grow fast so that we grow out of debt. But a skeptical part of me thinks it's probably going to be a combination of monetizing, raising taxes, and hopefully growing.
Ash, what does it look like from the bank's point of view, this scenario that will be unfolding in the future?
I can say history can only do one thing, it teaches us, right? So when you look at the 2008 to 2009 crisis, we called it the helicopter Bernanke, who dropped all the money.
Right.
All that $700 billion that was given to the banks to jumpstart the economy. I think if you go back and look at the statistics, all that money was paid back and handsomely back. Nobody lost money. That Mira is right about that we grew out of it. At the time when the money was given out to support the banks, the capitals were forced onto the banks to keep the banks alive. We all thought, how are we going to actually pay for it? A decade later, I think you could see that the history teaches us that the economy we are in is extremely resilient. The people that we have in our country are very ingenious and entrepreneurially driven. You just look at the last 11 years of where we were in the last crisis to where we are here before virus came on board. We never had that kind of economic stimulus put into our country, in our economy back then. And we thought, how are we going to pay for it? And we did pay for all of the money that was given to the banks. And I have optimism that we feel exactly the same way. The pent-up demand, the fundamentals are very strong. I think it'll take a little time to get back, but I always have confidence in our economy. And now we have track record that at least say $1 trillion, between 700 billion to 1 trillion was given to the banks, like we're doing 3 trillion now. And all of that within a decade or plus was done as a prudent measure and was paid back, and nobody defaulted, banks didn't fail. And the dividends that the government was supposed to make, did make. The government actually made money on that. So that's my view. I'm like Mira, is that I'm very confident optimism that we will grow out of this. And as Warren Buffett always says, never bet against the American economy and American people. And I'm a big believer of that.
All right. Thank you. Next question.
When do you expect the SBA will provide detailed guide regarding the 8-week spend that will qualify for forgiveness?
That's a good question. I think we are waiting. I think we got the first draft of the forgiveness come out yesterday. Not the second tranche of the monies are being distributed. The first tranche of forgiveness period, I think the details are coming out this week. We've got a rough framework of what we're going to have to provide. And I would say within the next 2 weeks, they will have to start distributing the guidelines of the conditions of the forgiveness prior to the 8 weeks. You don't want to wait till the end, and then all the banks are going to have an issue, because understand this, all $700 billion now between the two tranches is liquidity that's sucked out of the banks. The banks need that money back. I think you can go to the Federal Reserve and pledge those loans and get it back, but the forgiveness has to come back. Otherwise, you're going to start hurting the banks, because all the banks have done is advance the money now. Now they can pledge it and get the money back. So I think it's going to be very important next 2-3 weeks the banks start getting exactly the requirements for the forgiveness, so that period is going to come very quickly.
All right, next question.
So the next question is, how do you think that the coronavirus crisis will impact commercial and residential mortgage rates within the next 6 months to 1 year?
Then let maybe Ash want to take a lead on that, on the mortgage rates.
Yeah, I would think that I don't see, I think they're completely correlated to GDP, like you said, economic growth. I do feel like I think both our economists have said the interest rates are going to stay low for at least 12 to 18 months. And I think housing, we're a consumer-driven economy. 70% of our economy is driven by consumer and housing. I don't anticipate the economy having the inflation threat. The only reason we would raise interest rate is, unless Anil and Mira can correct me, unless there's an inflation threat, rates will go up. I don't see inflation becoming an issue, which would then default us to staying at this low interest rate for at least out to 12, if not 24 months. After that, if the economy continues to go up at 2-3% GDP and there's a threat of inflation, then it happens. The contrarian theory of a lot of people is that so much money is being thrown in the economy, will there be inflation? So that's a difficult question, because so much liquidity is being pumped in. But I feel the liquidity is being pumped in to fill a hole. It's not like we're already full and then the money's coming in, so there's a threat of inflation. So my answer is not anytime soon.
So, I agree with Ash. We actually have penciled in low interest rates for the remainder of this year and actually till the end of 2021, precisely because we think this recovery will be a little bit hesitant, a little bit tepid. At third quarter, great, but then high unemployment rates remaining until the end of next year and so on. So mortgage rates, we don't see any threat of inflation. I agree with you, Ash, not right now. Again, kind of a repeat a little bit of the Great Recession. I mean, you worry about inflation because all the money thrown in. It was about $3-4 trillion then. It's about $7 trillion right now, if you also count what the Fed has been doing. But again, you're filling in this big hole. You're shutting down the globe. Obviously, there is no economic activity to push into a string to push inflation higher. On the other side, though, we think mortgage rates will be low, commercial rates will be low as well, but there's a floor below them, and certainly our forecasts don't see them going below 3% or even 3.2%.
I agree. And if you look back at what the Fed was doing before the coronavirus started, they reluctantly started raising the rate, and then they changed their mind and they lowered them again. So I think it's not even 2021. I see low rates even beyond that until economy is on a solid footing and the growth really picks up. Now, I know Jeff has some views on Fed policy, low interest rates. He hates them, negative rates in particular. But I think we are in a low growth environment. Unless Jeff wants to add something.
No, I agree with you guys. I just think that in terms of traditional monetary policy, you have to think about velocity's been dropping for quite some time. So when you just add more money supply, it just drops velocity. And I think right now that we don't really have an economic multiplier. It'll come back at some point, but I agree with Ash and the other panelists that it's going to take a while.
Okay, let's go to the next question.
Next question. Would businesses and commerce open up faster if government would protect business but not allowing lawsuit to be instigated for a period of time due to virus?
Can you repeat it again? I'm sorry, Monteza, you're breaking it.
Would the business and commerce open up faster if government provides some kind of assurances that lawsuits will not be permitted due to the lawsuits?
Lawsuit will be permitted?
Well, not.
Yeah, I think I know him. Go ahead.
I can answer that question. That's a very good question, because here's what has already happened. There are 3 lawsuits already filed against B of A, JP Morgan, and Wells by small businesses for not giving the money. Supreme Court that has stopped the proceeding from going further because they already filed lawsuits. You just think about what a banker is going to do about the PPP loan when that kind of legal threat comes in. I'll just pull back out, right? Because we have shareholder money. So it's a very good question that the government has to protect some immunity that they should have so that we can continue to do what we're supposed to do. When the small business advocacy comes up and says there's favoritism, now you have to do transparency, and there's lawsuits that get filed, they have unintended consequences of that. It slows everything down. So I think it's a very good question that there should be some protection, some immunity to get back to the business, because I would say the negative effect of the virus, nobody controlled it. It was nobody's fault, right? It wasn't anybody's fault. So you can't blame the liability to where it should lie. But if you don't protect that, it's going to have a very, I'll call it unintended consequences, as it's already happening with bankers. The big banks didn't want to lend because there wasn't a full immunity by the Federal Reserve or SBA on the guarantee of the loan, and there's still not specificity. That means we are not sure if we're protected if we loan the money out to the people that really need the money.
Let me ask an additional related question for both Jeff and Ash. What do you think about the rate of bankruptcies, especially for smaller businesses, going forward through 2021? Of course, there'll be more bankruptcies, but what do you feel is the extent of that? Is going to be the extent of that?
Yeah.
Ash, please go ahead. I think that but I think you're the expert there.
I think it'll go up, substantially go up in my mind. The bankruptcy laws are there between 7, 11, and 13. I think some of them may be forced to do that. Some of them will take it as a strategic opportunity to restructure debt. You know, JCPenney just filed bankruptcy or getting ready to file bankruptcy already. So you're going to see some large companies that are going to go through, like Forever 21 went through it even before this. The tenant, the landlord, the rates are going to be so high. And, you know, when you look about crowd industries, they call it, when you look at industries that depend on large crowds like malls, and you look at entertainment like Super Bowl and football and baseball and all the games, it's going to get very, very difficult to sustain the revenue standards under the new norm, as we call it. So I feel like the bankruptcy rates are going to go up, some strategic and some compelled. They will have no reason, they will have no alternative but to redo their business by bankruptcy. It'll go up.
I think I just add, Anil, from the standpoint of, you know, I showed you the two markets. Well, we don't really have a stock market for small businesses. And, you know, it's really, as an American, this is just a tragedy for me to see this. And, you know, I really do hope that we can reopen in a responsible way, because if I had to pick one thing, if I was forecasting, if I was an economist, I would look at the small business, you know, in terms of your unemployment rates going forward, because, you know, when you restart a restaurant at 50% of capacity, it doesn't really help. So I'm not exactly sure how we're going to get out of this, but boy, I sure hope we do. And that's really the only thing I could say.
Thank you.
Oh,
I'm sorry, go ahead, Mira, but let me just say, we're going to take 2 more questions only, then our time is up. Go ahead, Mira.
So if I could add one small thing, yes, part of our forecast, the reason why we're forecasting a bit slower, sort of a W-shaped recovery, is precisely because we do think small businesses are having a hard time. If I can share a survey that was done by JP Morgan Chase, they actually asked businesses that are going under, basically about 3% of restaurants that have already closed down, about 15% were saying they're going to close down by the end of this month. This is a complete tragedy. And if you think, as I mentioned, in the local market, small businesses employ, in Orange County, 51.4% of employment are small businesses. That's why I think, you know, if these scars become permanent, the harder it will be to actually get out of this crisis. Something that started like a temporary shutdown will leave some permanent mark going forward. That's the unfortunate part of it.
I agree. Go ahead, please. Next question.
So will this be the end of the global supply chain, or just a realignment? And how much of the realignment will end up coming back to the United States?
I think it's an open-ended question. There is no doubt that some significant changes are going to take place in the way we do business. Once the normality, whatever that is, returns, the economics will still play its role in terms of firms producing where the costs are the lowest. It doesn't have to be necessarily China, but maybe other developing countries. Some of it will come back, but it truly is a significant event that will change supply chains in significant ways.
And I think Jeff had a very good point, which is exactly that this is sort of a reshaping of the global supply chains, reshaping of global trade. This is actually exacerbating a trend that started about 3 years ago, since policy has changed in the US as well. But this certainly will give it the final push where you will see a rejiggering of supply chain. Jeff, do you want to add more?
No, my only thought was that, agree with all you say. I never thought the heavy reliance that China and the US had was healthy to begin with. So I think it would have changed ultimately. This just accelerates it. And I think you should think of it, even though it's maybe a negative in the short run, I think in the long run it's a positive because we want more diversification in supply chains.
Exactly, I agree.
Last question.
Last question is the easy question, and that is, can we share the screenshot of some of the content on social media?
Yes, of course. We will make this presentation available at the Wood Center website. It'll take us a couple of days, maybe sooner, but as soon as we can.
We do have a longer presentation, so we can make the full deck of slides. We only shared the highlights here, so we'll make that available in a PDF format, correct, Anil?
Yeah, sure. That is currently available on YouTube and Wood Center site, the full presentation that we did a few days ago. Well, thank you very much, everybody. We appreciate your time, and we will see you in fall, hopefully in person. Thank you.
Thank you.
Bye-bye. Thank you.
Thank you so much. It was a pleasure.